Hi, welcome to the InterAxis channel and InterAxis.io. We're going to keep talking about all the different ways that cryptocurrency, digital assets, decentralized finance, blockchain are going to impact the way you look at your financial planning, your financial life, your financial advising in the future. Okay, and some of this is happening now, and some of it will happen in the near future, in the midterm, in the long-term future. First, subscribe here on YouTube if you're watching here. Visit us on Twitter at InterAxis8. Check out our academy, InterAxisAcademy.com, and learn more about Bitcoin, about crypto, wallets, custody, DeFi. So we're going to talk about buckets, income yield, all the different ways you can think of your money and your investments, and the different way to look at it as it pertains to not only your investments but your financial life. So this is coming somewhat from the idea of the financial advisor and how we in the past have looked at assets and looked at investing, and how most people look at their investing and how most people look at their financial life and how things are going to change. So first what we'll do is we'll kind of roll through the way we look at our money. And this is not the way we as advisors always look at it, but this is the way most people kind of look at their money. This is somewhat behavioral, right? You have some level of income, and generally this is from some sort of salary or some way that you earn money by doing some sort of work, right? You might also have some income from some investments you made, or some family investments or something, or something like that. But for the most part, it's income that's generated through salary or 1099s, or however you generate your income. And then you have your expenses. And whatever's left over, income minus expenses, you put towards some sort of savings. And this savings can be, you usually have some sort of emergency fund, you have some sort of cash, something like that. And then you have, you maybe have something you're saving for retirement, and then maybe you have something that you're saving, some extra money that you're saving and hopefully investing and hopefully growing, that isn't necessarily tied to retirement, and of course maybe then you have college or something like that. So you have other sort of, we usually call this brokerage or something like that, where you're saving into, stock, into like a brokerage account, something like that, or maybe if you're a high net worth, maybe if you're an accredited investor, you have the opportunity to get into something like real estate or private companies or some other type of investments you can make, but it's something that's not tied, doesn't have the rules of retirement, and your emergency fund is generally cash. Right, it's generally money sitting in your bank, and then you have things like I got to pay off credit cards and such. You have other issues and other items like that. So whatever your income minus expenses are is whatever you can save, and then of course you have money you just want to spend for fun. So in the past, the kind of the way we've done things is you figure out what your income is, you figure out how to, what those expenses are. Hopefully you save some goes to retirement, some goes to brokerage, what have you. And in the past, the way we've looked at this is this savings goes into some growth, some level of growth, some level of income. Okay, and the growth is generally, things like stocks or funds of stocks or something. The goal here is I want to invest in something here that's going to go up in value, that the next person is going to pay more for. It's going to go up in value. It's usually stocks or funds of stocks. Income in the past, and this is very general, has been things like bonds, which accrue, which grow, which pay some sort of interest, or dividend paying stocks, which pay dividends to you. It's a way that you're earning income. So even if the value is going sideways, it's still kicking off income to you. Now generally what happens, and again not all the time, but generally what happens is whether this is inside a retirement account or a brokerage account, you just keep rolling it back in. So even if you get income, you roll it back in, and it goes back into the, when we say the words 80-20 or 70-30, usually what we mean is 80-20 growth income, 70-30 growth income. Okay, that's generally what we talk about. And usually the income that's generated here just gets rolled back in, and then we rebalance as necessary. So if growth goes way up in value at the quarter, we'll sell some of that, go into income and rebalance. And the purpose of the income generally is it's relatively flat in terms of the value of the investment, but it's growing because it's always kicking off income. So even if the growth portion is going down, you're always getting something, but it's usually just rotating within this account. It's not that often especially if you're not retired yet, it's not that often that you actually take this income out and do something with it. That's just, and there are people that do that, but generally we just don't think of it that way. We think of this is our savings and our investments, and it's going to stay in this little bubble, this little bucket. We're going to have our income, and our expenses are going to get paid out of that. Now, sometimes this income portion can go towards something like real estate. It can go towards something like private companies, especially if you're a accredited investor. You can get into real estate, you can get into private real estate. Some people get into flipping homes. Some people have homes that they own for income, for the rent. Some people have other real estate investments. You invest in private companies, maybe private equities, hedge funds if you're to that level. Oil and gas, things like that. What those are is generally very illiquid. I can't sell out of those usually very easily. There's generally not a secondary market for those. Okay, so if I'm in those, usually that income will maybe come back to me here, but remember those are very illiquid investments. Okay, so if I put $100,000 in something like this in real estate, and maybe it's paying 5% or 6% or something, $6,000 a year, maybe I include that as my income, and hopefully I still get to save a good portion of that, and then I got to calculate tax purposes and everything. So all of that to figure out, okay, where do we have different options now? When we start seeing crypto, DeFi, and such, is now this savings and such can be skewed. And part of this is, very personal. This is kind of how I look at some of this, that you are going to have more options for this income portion over here that are not necessarily illiquid, and that are that you don't necessarily have to be an accredited investor or a high net worth investor for. And so you can maybe take some investment into something that is in this case crypto related or blockchain related, because that's how it's done now, and it might not always be that way in the future, but something that can be liquid and can generate income for you. What do I mean by that? What if you took some of this money and you invested it into, again, we're not saying you do this, I'm not giving any investment advice, I'm not telling you to do this, but what if you invested it in Bitcoin miners or helium miners or staking or something like that, where some of my money is going in here. I hope these tokens go up in value, but it's going to kick off income to me. If I'm Bitcoin mining in the form of Bitcoin every month, basically every day, it's going to kick off some Bitcoin to me. So I might invest, and I can either choose to invest just in Bitcoin and hold it, or I can choose to invest in a Bitcoin miner that's actually going to kick off Bitcoin to me every month. And now what I might think of, and the way I think of this is, okay, if I invest like that, what of my expenses am I going to get to tick off every month because I invested in something that's generating income? So let's say I put some money into Bitcoin miners, and I go, okay, that's going to generate enough money. If Bitcoin stays above a certain price, it's going to generate enough money for me to pay for my kids' school every month. Okay, so kids' school is paid for. So my expenses have gone down by the amount of school because I have this investment here. That means that might free up other things for me, right? That might free up money that I can put other places. That means maybe I don't need as much of an emergency fund. Not that I don't want as much of an emergency fund, but it allows me to move things around more and be a little more flexible. Because now, even if I'm not an accredited investor, I can do something like that for a relatively small investment and be kicking off income to myself every month or every quarter or whenever, every day in the case of Bitcoin mining. Again, this doesn't have to be Bitcoin mining. It can be staking. It can be picking a token and staking it. And in that way, you're participating not only in the growth, but in the income of it. But the way you think of it from an investment perspective is, I might be converting this every month into dollars that I can use to pay the school. And again, we're not going to get into the tax implications of that, because that's something you have to talk about with your advisor and your CPA and really work on that. But that's just a different way that you're going to be able to think about your financial life. Because for years, we haven't had this ability here that's very functional, because bond yields have been so low, interest has been so low that this is almost non-existent. You're doing this in the hopes that it just holds its value, but interest rates have come down so far that they're not paying very much income. And at this point, with interest rates as low as they are, if you buy a bunch of bonds and interest rates kick up, your bonds are actually going to lose value. Okay. Now, dividend-paying stocks, a lot of stocks are just not paying that much dividend anymore. There are some that are paying decent dividends, but they don't have to anymore because interest rates, because bonds aren't paying. So stocks don't have to pay that much in interest or in dividends because they don't have to beat the interest of bonds. Then you have real estate. Well, this is highly liquid and you have to be accredited. If you're going through an advisor, if you're going through something like that, you have to be accredited. Or if you're doing it personally with friends or with a company or that's part of your investment, that's highly liquid, and it's a lot of risk to take to invest in a lot of real estate. It's just some risk, and it might be a while before you see a return, and there's ongoing management to it. Okay, so we haven't seen this portion able to generate a lot of income easily, and now we're getting back to that. Crypto, ironically, is getting us back to the idea that I can generate income from my assets and from my investments and utilize that on a regular basis to maybe be able to pay some of my expenses. Now, what does that do to the rest of my portfolio, the rest of my financial life? Maybe it frees up some of my ability to save some more because I've invested here and I can keep paying these expenses. And maybe, I invest in this and Bitcoin goes up in value, and now maybe it pays more expenses. Maybe now, Bitcoin, goes up 20%, and now it funds my car every month, my car payment. Well, now I've got two things taken care of by virtue of the fact that I made one investment. And again, it allows me to free up other things. And maybe if my growth, maybe if this brokerage account goes down in value, but this is still kicking off income, I can let it come up in value before I sell things. Okay, it gives me more flexibility, more options. Again, we're not telling you to do this. This is something we're going to have to think through as we see more and more opportunities within the digital asset space to actually generate revenue with some of our investments or generate income with some of our investments, rather than just saying they're either growth or they're very, very low earning income that's just going to sit inside my brokerage account and recycle within itself. Maybe now it's easier to invest in some of these assets and use them. So if you're a financial advisor, you're going to have to know what some of these income producing investments are and how they fit the financial plan. If you're an investor, you're also going to have to know what they are, how they fit your plan, how to keep it safe, how to get involved, who to talk to, whom to trust. Okay, and it's really important, but it's so important because it's going to give us more options. And in the aggregate, more options means more opportunity, and we can be more efficient. It also means there's more opportunity for us to lose money. There's more risks, so we're going to have to evaluate the risks as well. What are the risks of these types of investment versus the ones that we know and that we've trusted and that have a lot of insurance behind them and have a lot of securities laws and regulations behind them versus the ones that are not as regulated but maybe pay off more income. So that's a little bit about some of the differences we're going to see probably more in the future when we start talking about all the different investments you can make and how it's going to affect our financial life when it comes to cryptocurrency, digital assets, decentralized finance. So hope you enjoyed this. Hope you'll subscribe here. Visit us on Twitter at InterAxis8. If you want to learn more about stuff like this, we have this on our academy, interaxisacademy.com. If you want a financial advisor that's starting to learn about this stuff, certified digital asset advisor, let us know. We'll hook you up with an advisor who's been through this. And we hope you enjoyed this, and we hope to see you in the next video.